Well, good afternoon. This is Michael Douville coming to you from beautiful Scottsdale, Arizona. It's the 1st of February, 2018. I realize that we've been talking about the twin bubbles, both of the stock and bond market, and what to do about your investments. So for a lot of people, there's some other considerations that we need to talk about as well. First, let's talk about interest rates. Interest rates have been trending down for the last 35 years. Since 1981, we've had lowering interest rates. Now they've bottomed, and not only they bottomed, but technically they've broken out of their channel, which means that once they do the breakout, it pretty much confirms the fact that we're no longer heading down, that we're heading up. And we broke the channel. We went to 265, and that was a significant level. And just yesterday, we went to 2.75, confirming that. And as of today, the 30-year broke the 3. So we have some confirmation that yes, probably the interest rates have bottomed. That's for sure. Keep in mind that in July 2016, Charles Nenner said that we've bottomed. That was at 1.36 on the 10-year. And of course, now we're at 2.75. So that makes a huge difference. It's doubled. Now, so what does that mean for people? Well, it means that your credit cards are all set up on interest rates. So people have anything that has an adjustable rate. So let's just think if you have an adjustable rate and you're in an increasing interest rate environment, you need to do something about that. So first off, you should be getting out of debt anyway. If interest rates are heading up and it's going to cause turmoil in the stock market, of course, the stock market seems like it's starting to weaken a little bit. Maybe it's just a short trend and it's going to turn around. We don't know. But, we've got all the central banks that have been coordinating. They've all been saying that, hey, we're getting out of the stock and bond market. So now all of a sudden market starts to tremble a little bit. So maybe they are. So if that's the case, then you need to listen really, really hard to something like that. And they also say they're getting out of the bond market. So if they're getting out of the bond market, just look what's happening in Europe. The the rates in Europe are going up, and pretty significantly. So it makes it much harder for anyone to really start servicing their debt. And of course, the average person doesn't have the kind of debt that small municipalities do. But the municipalities are going to be the same as everybody else, is that they're going to have trouble paying the bills. So if you have any investments in bonds, you need to really start thinking, what am I going to do? Because as interest rates go up, your bonds go down in value. Let's talk about something that's just a little more close to home. Do you have an adjustable rate mortgage? Investors, quite honestly, bought adjustable rate mortgages 10 years ago, and of course the rates have gone down. We had rates go down to 1% on the T-bill, 1.75% on the T-bill, and that made investment rates really 3 or 4%. Geez, how wonderful was that? That was just great. But of course, if interest rates are going up, that means those adjustable rate mortgages are going to go up. And they can go up faster than you think. So if there is a little bit of turmoil in the economy, that means that people will be taking their money and going to bonds. That's the typical scenario. Now, maybe it doesn't play out that way this year, but it wouldn't be unusual for that to happen, where you see interest rates go down. So that might be just a window of opportunity for you to refinance. So take a look. Do you have any investment properties that are on adjustable rate mortgages? Is your home on an adjustable rate mortgage? If so, you really need to start to think of refinancing. I think you're going to have a window of opportunity to do so. So let's take a look at that, because you sure don't want to be on something that you got your life based on a 3 or 4% payment rate, and all of a sudden see that start creeping up to 5 or 6 or 7. So could be reasonably significant. So let's get off that. Let's get off that train and get fixed rate. Same with your credit cards. You need to start taking a look at credit cards, pay them off, because as rates go up, your credit card is going to go up too. So we're talking about anything that you have debt on. You need to really review and see what can be done about that. So listen, it's just a quick video. Pay attention. Things are in turmoil. We've talked about you can review some of the older emails as videos as to what we should be doing at this point. So if I can help you in any way, shape, or form, please contact us, and we'll do the very best we can. God bless you now. Bye-bye.